Hello there. So we've heard all about increasing wages, national insurance, tax. So what can you actually do to help control your finances in the practice with regards to these issues? So although practices have typically seen a significant increase in practice profits in this last year, this doesn't mean that you can become relaxed about budgeting and cash flow. In fact, you might see more pressure on profits this year than in recent years, with the increase in the minimum wage we've heard about, the extra health and social care levy, increasing overheads, who knows how high they're going to go, and announcement today, bank interest rates are increasing again. So potentially also you might see a reduction in income with the tailing off of COVID vaccination income going forwards. It's therefore very important that practices are looking at budgets and projections for the coming year. But more importantly than preparing those is monitoring the actual results against those budgets. Leaving it until the end of year to see what your accounts look like isn't a recommended way to monitor and control your finances. If issues arise, you need to be aware of them straight away and take action to avoid possible cash flow issues in the long term. Although it's a difficult conversation to have always, it's better to have a conversation with partners about reducing drawings or spending rather than waiting till it's too late and then asking them to put money back into the practice. So looking at ways we can manage that uncertainty, there are several key factors in trying to manage uncertainty to ensure financial survival for practices. Ensuring that your list size is up to date. Are you being paid at the correct level? Much of the funding, as Jane talked about, is now based on weighted list size, and you can actually access calculations quarterly on PCSE online to look at how your weighted list size is actually calculated. So it is worth looking at those to make sure your list size is up to date and you think you're being paid correctly. Understanding the income that you're generating and understanding the practice accounts is essential. How are you paid for things? What are you paid? When are you paid? If you can monitor all of those, you can actually see then, have you actually been paid for your services? For every enhanced service that's been released, there's a detailed specification published online, which includes how you're funded for that enhanced service. It's got all the detail about what you need to do to achieve it, but also the funding. So it's important that you understand that to be able to monitor if you've been paid correctly. Areas where we typically see income missing is with flu vaccinations or historically childhood vaccinations where activity is not being recorded correctly, and therefore you haven't actually been paid for those items. It's less of an issue than historically, as a lot of the information is now automated. But if your GPs aren't recording things properly on your system, you won't get paid for those items. So you need to be aware when you're not getting paid. The other area that it's worth reviewing regularly is looking at the fees for private work. So things like insurance reports, HGVs, things like that. If staff costs are going up, as we've heard, they are going up exceptionally, why not inflate those prices? Average prices for private fees is listed in, I think it's in Mediconomics each year. You can look at that, but it doesn't account for regional variations necessary. I'd suggest if you haven't reviewed what you're charging for private fees recently, then now is the appropriate time to do so, and looking at perhaps increasing those in line with other increases. Ensuring that you've got funding in place for times when potentially the practice will need to rely on bank finance is also important. It's not always a bad thing to be using an overdraft or looking at taking out a short-term loan, particularly for one-off projects. Obviously, that's only if interest rates remain low. We know they are increasing and they're likely to increase going forwards, but at the moment they're still relatively low. Important things to have in place to make sure that you are monitoring things is to have accurate projections of tax liabilities and superannuation so that you know what you need to pay and when you need to pay it. That's essential. Considering the level of monthly drawings, not just annually, but also throughout the year. If cash flow is tight, should the drawings be reduced? If there are partner changes or if they're opting in and out of pensions, for example, are drawings at the correct level? I would say from our side of things, if you can please make sure that you update your accountants with any partner changes, whether it's pensions, session changes, anything like that, then we can advise you promptly if you need to look at amending drawings or not. Monitoring the costs as well to ensure that you're getting the best value for money is essential. This includes looking at all your utilities, but in particular, where we see possible issues with practices is a review of the procedures for purchasing of drugs and dressings. Many practices have found they've got a less than ideal system for the purchase, approval, and usage of stock and drugs and dressings, in particular for dressings. Practices need to regularly review procedures over purchasing and ensure that there's a rigid, secure system for stock control. Ensure that drug purchases and usage is matched to the submissions to the PPA. Practices also need to ensure that you're making a profit from PA items, personally administered items, because you aren't reimbursed for dressings and some disposable items, various things like couch roll. It's often worth splitting out in your accounts the actual drugs costs compared to those items. Then you'll be able to see what profit or loss potentially you're actually making on those PA items and monitor it more carefully. Looking at utilities, you need to be reviewing contracts with utility providers on a regular basis. Ensure you're getting the best deal. Obviously, that's going to be more difficult under current circumstances. All costs are likely to be escalating. Cleaning costs, for example, they're likely to go up because of the living wage increases we've heard about. So reviewing those contracts. Typically, over the past few years, we've seen an average spend of about £6 per patient on cleaning costs where you use contractors. That's likely to go up over the coming years. As well as reviewing spending, look at wastage. Are you wasting things? Are you printing too much? Are you posting out things when you don't need to? Are you wasting dressings? All those sort of things, for example, looking at wastage as well as spend. We'll look at some statistics later on, which show, probably not surprisingly, that staff costs equate to nearly 50% of your total income. So that's an area that you must ensure you've got tight control over. Reviewing the mix of staff, so looking at salaried GPs, partners, skill mix is a useful way as well to try and get more efficiency out of your practice. There's been a significant move over the last few years with practices using alternatives to partners, such as nurses, nurse practitioners, paramedics, pharmacists, these can be less costly than a partner session, which will ultimately increase partner profitability and maintain the workflow of the practice. So don't just assume that you have to replace like with like if you've got staff changes. Staff costs are the most significant expense of a practice. So having annual appraisals and a detailed review of working practices are essential in ensuring that all staff are working effectively whilst not being overburdened. A full-scale review of all jobs and workloads, we would recommend undertaking at least every 2 years. So if you haven't actually done a review of your staffing requirements, the roles your staff are undertaking, we'd recommend that's a good thing to do to ensure you're operating as efficiently as possible. Our view would be that the review shouldn't be carried out by the partners in the practice, but by managers with the full support and backing of the partners. Managers are likely to have a clearer understanding of the roles being carried out and the pressures of the individual roles. Another area that we can see costs escalating is with locum fees. It can be a big expense for some practices. If you're a partnership which relies heavily on locums, then you should be reviewing the need for locums. There's potential for partners covering holidays or restricting how many GPs can take leave at the same time with a holiday rota. More use of nurses are all options that you can take to try and cut that locum spend budget. It can be a contentious area as the use of locums is obviously a choice of profits versus lifestyle. And you might find that partners have differing views on that in your practice, but it's something that should be discussed and looked at if you want to look at maintaining profitability. Another recommendation is to have a proper maintenance programme in place for the building work. So on a rolling 5-year basis, say, So there's not a year where everything needs redecorating or replacing every 5 years. Instead, you have a rolling maintenance program, and each year you do a different area. This also helps with cash flow, and is also fairer if you've got partner changes, that you haven't got 4 years where you do no work and then 1 year where it's really expensive. Partner changes coinciding with that. So it can be a useful way of having regular spend over the years. It's not uncommon for practices we see to have absolutely no idea how profitable they've been until the year-end accounts have been prepared. If it's been a very profitable year, the partners are likely to want to withdraw their excess from their capital accounts, particularly if they pay tax themselves. The projections for the next year may not be very favourable for whatever reason, and so you might think, we'll pay out the money and not do any major redecoration work that needs doing. If a practice continues in this way, then many major expensive maintenance jobs that may be required will all come in 1 year, which have a huge impact on the profits and cash flow. So again, trying to spread those costs over a period is more favourable. So ways that you can help ensure that there's enough cash in the business and monitor your performance are looking at things like drawings projections, budgets, cash flow, and benchmarking. So I'll just go through each of those in a bit more detail, really. So drawings projections is the first area we'll look at. If your practice doesn't currently produce drawings projections, then we would highly recommend it's something you look at. For most of our practices that we act for, either we prepare for them or the practice managers prepare some projections of what expected profits for the next year will be. From this, we can then estimate what individual GPs' drawings should be, and from that, their expected tax and superannuation as well. It might vary from partner to partner. If, for example, someone's opted out of the NHS pension, or if they pay added years, or one partner has a particularly higher tax liability due to outside income, for example. This should all be factored into drawings projections. We do quite often see where it's just based on sessions worked, and then at the end of the year, the capital accounts become very unequal for the reasons mentioned above. Typically, when we're producing drawings projections, we include a contingency for unknown costs, and we err on the side of caution. So it will be pessimistic drawings projections, so that partners are never in a position where they've overdrawn and have to put money back into the practice. It also avoids the scenario where there's a disparity in the capital accounts, which can cause issues if one partner, for example, builds up a large capital balance compared to other partners, and then leaves, putting huge pressure on practice cash flow. It can also be a useful tool that we use to look at potential partner changes to see the impact on drawings. So if you're considering taking on an extra partner, increasing sessions, we can amend those projections to see what will the other partner's drawings look like if you make those changes. So the next thing then to look at on from drawings projections is looking at budgets. So drawings projections are closely linked to budgets. The difference between these is that for a budget, we'll look at items on a line-by-line basis. For drawings projections, we'll just look at what do we expect the total profits to be. Most softwares, if you're using online softwares, have a budgeting facility within them. Some of those aren't particularly user-friendly, so you could choose to use just a simple Excel spreadsheet. You can also export from the software to Excel and then tweak it to present it how you want it to be. So there are tools there which aren't that time consuming to get these budgets set up and in place. The starting point for producing any budget is to look at last year's accounts and then look line by line and adapt for what you know will change. So specific things that you might look at when you're looking at a budget. One of the most important, not surprisingly, expected changes to staffing, looking at pay rates, looking at new staff that you might want to take on, for example, and factoring that into that budget. Including an estimate of the increase in overheads, tricky at the moment, who knows where it's going to escalate to, but our advice would be to overestimate in the current circumstances what you expect those overhead, light and heat expenses to be. What do you really ideally want to spend on repairs? So put what you'd like to do first in the budget, see how it comes out. If actually it looks like you can't afford that, then you can tweak it and decide what repairs you are actually going to undertake. What's the increasing in core funding going to be? So based on what Jane talked about earlier on in the session, we know what uplifts you might get. Factor that into your budget. What new enhanced services might you take up if new ones are offered in the year? What's that, not just what that income is going to look like, but are you going to have extra costs in staffing and overheads attached to that income as well? So factor that in. What's the impact of a likely increase in interest rates? So going back a couple of years back, you could probably have a fixed 25-year loan for about 3% you'd probably pay. Now you're looking at about 7-8%, and that is undoubtedly going to increase over the next few years before it starts to come back down again. If you're on a variable rate, obviously you'll be impacted more by that than if you're on a fixed rate currently. By having a budget and detailing line by line what you expect to receive and spend, and then reviewing this against actual results, either monthly or quarterly. Quarterly is probably better than monthly. You can easily see if costs such as locums or staffing are escalating, or if you haven't received income for a quarter for a particular enhanced service, for example. By looking at the information, at least quarterly, you'll then be able to take action immediately to chase missed income or review suppliers promptly, rather than it being 12 months later or longer after the end of the year accounts are finalised. So then moving on to look at cash flow. So the difference between a cash flow and a budget is that a budget doesn't look specifically at the timing of payments. A budget will just look at income and expenses, the profit, whereas a cash flow is looking at all payments in and out of the bank. So including drawings, superannuation, tax, bank loans, which don't feature in the income and expenses. The point of a cash flow forecast is to look ahead. So it should be at least 12 months, ideally more, to highlight if there's likely to be a time in the future when you're low on cash, or equally if it looks as if you're likely to have surplus cash to afford an equalisation payment potentially. You can easily look at the bank today and see you've got 200,000 sat in there and think all is good. But in reality, if you have to pay wages, drugs purchases, perhaps you've got rates rebates sat there from years back you haven't repaid yet, superannuation balances for a couple of years that haven't been taken by PCSE. And if the practice is paying the partner's tax, which you might have to pay in the next few months, is there still enough in there? You can't really tell from just looking at that bank account if that's the case or not. Cash flow can also be impacted at times such as partner changes or with changes in premises that can put one-off pressure on cash flow. So by using a simple Excel spreadsheet really is all we recommend on a month-by-month basis to record what payments and income you expect to go in and out of the bank, you can easily total any surplus or deficit cash month by month. By just adding your opening bank position to that surplus or deficit each month, it will give you the predicted closing bank position going forwards. And this can be set on a rolling basis. So each month, if you replace the projected opening bank balance with the actual balance, add a month, you'll always have peace of mind that there won't be an issue with cash flow in the future. We've got a simple performer that we use for Excel. If anyone would like a copy of that, then please email your usual contact at Lentils or any one of us and request it, and we can send it across to you. You don't necessarily have to do this on an item by item basis. So for example, you can group NHS England income and CCG income, group staff costs all together, group premises costs all together if you wish. So it can be quite simple, but what is important, it has to be realistic figures and you have to keep it up to date. If you don't, it will be meaningless. For staffing, ideally, you'll have a separate staff budget detailing staff individually, looking at their own costs and review that on a regular basis. A cash flow forecast can be really useful when you have to decide if you can afford to redecorate, for example, buy new equipment or give a staff pay rise. You can easily just pop the new expected spend into the cash flow spreadsheet and it will show you in 5 months, 6 months, 12 months, if you can afford to do that. If you find your cash flow forecast shows an overdrawn position in, say, 9 months' time, it gives you the opportunity to have a discussion now with your partners about how to deal with that. Options might be to have an overdraft facility. It might be that partners need to increase their working capital requirements, which they can then build up over time if you've got that advance warning that you need to do that. Many practices choose to run on low working capital balances and have an overdraft facility in place. It's a relatively cheap way of funding this short-term overdraft. In the past, with increasing interest rates, it might not be as attractive, but something that you need to review. The final part I just want to talk about is benchmarking. So this is the part that's not so easy for you as a practice to compare how you're performing compared to other practices. We produce benchmarking statistics for over 190 practices that we act for, covering the Southwest, to compare practices to come up with some average statistics. This is published in our medical newsletter each year in autumn for the previous year. To ensure that all the practices are comparable, we treat a whole-time equivalent as 8 sessions and also treat salaried GPs as if they're whole-time partners, so that we're comparing practices regardless of their structure. All statistics are based on raw list size rather than weighted, and we split out dispensing and non-dispensing profits. So we've extracted just a few of the key statistics, really, for you to look at today. These are based on the current year today, which will alter every time we add a practice. But in reality, it's just the December year ends that are likely not to be on there at the moment. Also included here, we've got last year's figures for comparison as well. So the list size per partner is lower this year compared to last year. I suspect because of those changes in structure that I talked about, where practices are using non-GPs to cover partner sessions. You'll also see average profits have increased quite a bit from 120,818 to 136,764, which isn't a surprise with the additional COVID funding that practices have received and also additional funding from PCNs. We've seen that increase quite a bit in this last year. Just going on to the next slide, then we can look at wages costs is always an interesting statistic, but can actually be quite subjective. It very much depends on who you employ. If you've got a lot of nurse practitioners, pharmacists, for example, your figures will certainly be higher than average, or if you've got multiple sites, then your figures are likely to be higher than average. But it does give a good feel for where you sit compared to average for other practices. Profit per patient has also increased, which isn't always the case if overheads increase in line or more than income, which might be the case for the current year. Several practices have seen savings in locums over the last year, and also savings in things like postage favouring electronic communications. Together with inflationary increases in core funding, but particularly increased income from COVID and PCNs, has boosted that profit for this year. So average wages costs, as I said, have increased from 71.56 to 76.89, and will continue to do so with the increased living wage. Additional clinical staff covers things like paramedics and pharmacists. That's fallen, and that is because a lot of those are now employed via PCNs rather than through practices directly. So there will be more of those being employed in practice, but largely via PCNs. It's probably no surprise, just onto the next bar chart. Looking at this one, no surprise there that staff costs, as I said earlier, I think nearly 42% of your costs are staff costs. Perhaps surprising that it's reduced compared to last year, but don't forget this includes things like staff welfare. Staff will have been working from home over the last period, less socials, things like that. So I think that probably contributes to that quite a bit. It will also include things like training and courses, which wouldn't have happened with COVID going on, perhaps over the last couple of years. Then finally, just looking at the dispensary statistics there. So looking at dispensing, the number of patients dispensed to has actually increased slightly, and the profit per patient has increased as well over the last year. Perhaps more efficiency with the pandemic has led to this increased profitability. The profit margin on drugs has also increased compared to last year, so looking positive for dispensing practices, which had seen a decline in profits over the last couple of years, really. So if you wanted to try and compare your accounts to these statistics that we produce, what do you need to consider? So the cost of salaried GPs should always be added back to your profit, and those salaried GPs should then be treated as if they're partner sessions. You need to check how employer superannuation is treated. For our clients and for many other practices, it's shown as an expense in the accounts. But we have seen for some accountants, they show it in the capital account along with employee contributions. So you need to check if that's comparable. The other main thing is partner subscriptions. Some practices pay that on behalf of the partners and it's an expense in the accounts. Others, partners pay it personally and include it on their personal expense claims. So you need to ensure those are included in costs if they're paid personally by your partners.